Good morning, everybody, and welcome to the Shenkman Private Client Group Accountant Attorney Fall webinar series. This program is entitled Federal Taxation with Proper Representation, a primer on IRS civil and criminal tax controversy. For those that don't know me, my name is Jonathan Shenkman, and I'm a financial advisor, portfolio manager, and accredited investment fiduciary at Oppenheimer based in New York City. The goal of all my programs is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 15-20 events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You can read my work in Barron's, Forbes, Kiplinger, the Wall Street Journal, the CPA Journal, Trust and Estates Magazine, and many other periodicals. My most recent piece was published in Forbes entitled 7 Strategies to Generate Sufficient Cash Flow in Retirement. After the program, I'll send out a link to this article and a variety of other periodicals where I publish my work. Today, we're privileged to hear from Richard Kestenbaum and Scott Kestenbaum, both from the law firm Kestenbaum and Mark LLP based in Long Island, New York. Richard Kestenbaum began his legal career in 1974 as a lawyer with the Office of Chief Counsel, Internal Revenue Service. In 1980, Richard left the government for private practice and shortly thereafter formed Kestenbaum and Mark. Richard represents corporations, individuals, and estates concerning sensitive domestic and foreign tax issues resulting in civil and criminal controversies with IRS and state and local tax authorities, including related litigation in state and federal courts. Richard has been selected as a New York super lawyer and Long Island top legal eagle. Scott Kestenbaum represents corporations, individuals, and estates concerning domestic and foreign tax issues resulting in civil and criminal controversy with the IRS, New York State, as well as other state and local tax authorities, including related litigation in state and federal courts. Scott was selected as Super Lawyer Rising Star in Taxation. In 2019, Scott was selected to Schnapp's Media Stars Under 40 and named co-chair of the Nassau County Bar Association Business Law, Tax, and Accounting Committee. Today, Richard and Scott will be speaking on federal taxation with proper representation, a primer on IRS civil and criminal tax controversy. And with that, I'll turn it over to Richard and Scott.
Can you see the screen?
Yeah, everyone can see. We can see everything.
Perfect. So thanks for having us, Jonathan. As John mentioned, I'm Scott Kestenbaum. This is Richard Kestenbaum. It's a short agenda, and we'll try to dive right in because we don't have that much time. I'm going to spend a little bit of time talking about IRS collection and the IRS civil side of collection. We will then touch on employment taxes, and then Richard will go into civil and criminal, mostly criminal tax issues so that we can discuss some of what's going on. And then if we have time, we'll get into the role of the accountant in sentencing, and then any questions you have, you can ask after. Try to breeze through the presentation as much as we can. I'm going to move pretty quickly. Certainly, if you would like to have a copy of this information, we're happy to send it to you after. You could just send us an email. So here we go. IRS collection. I think most people know this, but just as a brief summary, how does tax liability arise? Tax liability arises generally from self-assessment. Taxpayer files a return. They voluntarily send in a return or an amended return and they report the tax. However, there are other ways that the IRS can assess tax through a traditional audit process, through an underreporting program, or a substitute return. Generally, these two happen when the IRS has reporting information like a W-2 or a 1099, and the taxpayer did not file a return or did not include this information on the return, which then causes the taxpayer to receive a notice from the IRS that they didn't include this information and to file a return properly. There are jeopardy and termination assessments. Both of these are fairly rare, but these give the IRS the opportunity to assess right away. There are trust fund recovery penalties, which we'll get into a little bit later. And those are the main sources, the primary sources of collection for the IRS. Now, two main ways the IRS collects. Generally, most taxpayers see this. It's either a lien, where the IRS will file a lien against all property and rights of the taxpayer. One important note, and I find that I get this question a lot. When a lien is filed, and let's say you get a title report and you're selling a piece of property and you see a lien and the lien says taxpayer owes $1 million, that doesn't necessarily mean that the taxpayer still owes $1 million. Okay, so once the lien's filed, whatever that balance is at the time of filing, that's the balance that's showing as due on the notice. But if the taxpayer pays, let's say it's at $1 million when the lien's filed and they pay $999,999 and they still only owe $1, the lien is still going to show as $1 million. It's not going to show the additional interest that's owed. It's not going to, and it's not going to show the exact balance that's still due. So you have to reach out to the IRS or the revenue officer that's assigned and find out what's due to try to resolve the balance. There's also levies. The IRS, again, has not done a lot of these lately because of COVID, but the IRS can file a levy against any bank account the taxpayer has to try to collect money that's due. However, there are certain ways you can protect your taxpayer from collection. If you send in an offer in compromise or you set up an installment agreement, then the IRS cannot take collection action. Also, during the time that the offer is pending, the IRS can't take any collection action either. So if you send in an offer, generally the IRS will take lately about 12 months or so, maybe 14 months to review the offer. No collection action is taken. There are also innocent spouse claims, which we won't get into today, but too much, but it's important to know that during an innocent spouse claim where a spouse is stating that they are not responsible for the tax liability they've been assessed, there is no collection action taken, and then we will get into collection due process requests. The IRS can levy during a collection due process request or equivalent hearing if collection is at risk or the taxpayer has raised a frivolous issue. Again, a rare occurrence, but does happen from time to time if a taxpayer tries to avoid collection action through some frivolous act. Some notices to keep in mind, and important to know that the IRS has actually stopped sending these notices as of August 21st. I imagine they will start again probably in January. The IRS shuts down for the most part in December, and the computer system gets rebooted and reconfigured, but these notices will start to go out. So just to keep in mind, because a lot of these notices look the same but have different meanings. A CP 501 is a notice that just shows there's a tax balance due. Generally, no collection action is taken. It's just telling you there's a balance due. A CP 503 says that there is a balance due, and it's sort of a second reminder, by the way, you owe this balance. The two notices to really watch out for are the CP 504 and the LT 11. The CP 504 is a notice of intent to levy. The words on the notice are a bit harsher than a CP 503, and it tells the taxpayer you must pay by a certain date. And the LT 11 is the most important notice because though the language has changed, it specifically states that you have 30 days from the date of that notice to respond. And if you don't respond, then the IRS has the right to issue a levy.
The caution here is the first three all look alike. The language and the appearance of the form look alike. So be very careful to look in the upper corners and see which form they actually sent.
And the language has also changed on the LT 11. So it used to be very clear on the first page, then they started showing it on the second page. So make sure you read all pages of the notice because you will see a date that you have to respond by. And that is the key date that you need to keep in mind when avoiding collection action. So a little bit more about the final notice. I've found this happen a few times. When the requirements of a final notice that it's sent to the taxpayer's last known address and it's sent by certified mail. And for a lien filing, because the IRS can file lien at any time, it must be sent not more than 5 business days after the day of the filing of the lien. Sometimes the taxpayer will file a tax return and the IRS will not look at that last filed return and will send it to the wrong address. You have the right to then challenge that it wasn't sent, that the CDP wasn't sent to the right place. Excuse me, that the final notice wasn't sent to the right place. But the most important form to keep in mind for CDP hearings is IRS Form 12153. This is the form that has to be filled out and sent back to the IRS to prevent collection action. It can be faxed in or mailed in. And while you have 30 days, it's very important that you get it out by the 29th day. I have had issues where I sent it out on the 30th day because the taxpayer didn't get it back to me. And you end up sometimes in a fight with the revenue officer because it wasn't sent in timely. So just make sure if you're going to watch the date on these notices, send it in a day or so before it's due.
Make sure you send it to the address shown at the bottom of the form. It's not always where you think it should go. It doesn't go out to the service center.
So I'll just mention briefly on this slide, which tells you a little bit more about CDP rights. The notices which trigger those rights are federal tax lien notices, notices of intent to levy, notices of jeopardy levies, and final notices. There is one box you will see on the CDP form. It's an equivalent hearing box. So if the taxpayer fails to make a timely CDP request, if they don't make it within that 30 days, you still can request what's called an equivalent hearing. The difference between a regular CDP and an equivalent hearing is that you are not subject to tax court review. If you file a timely CDP and you then get rejected at appeals or your case, they sustain whatever the determination is, you can then go to tax court and challenge it further. You cannot do that with an equivalent hearing. So you will have your right to go to appeals and speak to them and try to resolve the matter. But if the appeals officer makes a determination that you don't like, you cannot challenge it in tax court. Okay, that's very important to know. Just a few tips to keep in mind when speaking to the taxpayer. Were the liabilities discharged in bankruptcy, or can they be discharged in bankruptcy? So we are not bankruptcy attorneys, I will just preface that, but there are certain liabilities, for example, income tax liabilities that can be discharged in bankruptcy if they're older than 3 years. There are certain rules and things to keep in mind, but that's something important to know. Trust fund penalties cannot be discharged. So that's another important fact. This one has come up actually 3 or 4 times in the last few months. Did the statute of limitations expire? So the IRS has 10 years from the date of assessment to collect. Now, the IRS is not taking collection action right now, but but the statute is continuing to run, and it's continuing to run on all the liabilities. And I'm not even sure when the IRS is going to really start collecting again. So there are taxpayers I've had that had statutes that were due to expire, and they expired. And when they expire, the liability is written off and it's no longer due. So before you reach out to the IRS, you should focus on number 5, these different tools to confirm that the assessment has expired or is going to expire. You should pull IRS account transcripts, which provide a summary of each tax liability. They call them tax modules. You can also look at IRS wage and income transcripts. That'll show you if there was anything filed with the IRS with regard to income. So if a taxpayer tells you they're not sure if they reported something, you can verify that because you can look at the wage and income transcripts. And you can request these through IRS e-services. So you can create an e-services account or through the practitioner priority service. Generally, I find that when you do take either of these options, it doesn't cause the IRS to try to take action. The practitioner priority service is just going to tell you the information. They don't really take any further action, so you can use them as a resource without worrying about the IRS taking action before the statute expires. Tell you a little bit about offers and compromise. There's 3 ways to apply for offers, and there's a lot of taxpayers now with liabilities who aren't paying. Either they had a past liability or have a current liability because of their 2019 taxes that were not paid due to some financial issues from COVID. You have a doubt as to collectibility offer. That means you have the inability financially to pay. A doubt as to liability, which is when you don't believe that you owe the liability. This often happens with trust fund penalty cases where there are responsible officers and an employee who signed checks ends up getting assessed as a responsible officer when they should not have been assessed. Should always challenge that. And one avenue for doing so is to a doubt as to liability offer. And then the third is an effective tax administration offer. The question is it in the best interest of the IRS to accept an offer despite the taxpayer's ability to pay? These kinds of circumstances happen when there are very unusual facts and there is a reason why a taxpayer deserves an offer despite the fact that they have some available assets and or net income. Some forms to keep in mind: 433A is the main form, and a 656 is the form where you outline how much you're going to put down, 20% of that offer, and your payment plan, which is either going to be over 5 months from the date of acceptance or payable over 24. One tip, and this came up for me a few months ago, there was a new form that came out during COVID. A new 433A, it's effective as of April of 2020, and that new form raised the application fee from $186 to $205. If you don't send in the $205 and you take the position that you just had the old form, they will send back the offer and return it to you, and your taxpayer will end up back in collections. So just watch it. We're talking about very few dollars, but the impact on the taxpayer of ending up back in collections is far more important.
The reason the doubt as to liability offer and compromise is valuable is because many times people don't get to or don't properly challenge the liability in an employment tax situation. And this is kind of a backdoor way to give you your appeal rights on that.
2 other tips. The most important tip, because I'd like to move to some of the other slides, is make sure you review your client's expenses in conjunction with the IRS Collection financial standards. So that link is going to take you to the standards. So depending on where you live, how many people are in your household, there are certain food and clothing collection standards, there's housing and utility standards, there's public transportation standards, automobile standards. All of this is very important because when you're reviewing a taxpayer's expenses, just because a taxpayer's mortgage, for example, is $6,000 doesn't mean that they are allowed that amount as an expense. What the IRS will say is a person living in your area could afford a house where they're paying $3,000, and they essentially just do not include the extra $3,000 you're paying as an expense as one of your expenses.
Essentially creating additional income that you have to pay on a monthly basis that doesn't really exist. But I have found that the revenue officers don't follow the national standards exactly. They will sometimes, the understanding that in New York, the cost of living is higher than in other parts of the country. They will stretch a little bit above the national standards within some reason. They don't want to see your client living in a, $5 million mansion and paying a huge mortgage, but they will give some more than the national standards in many cases.
Another key fact with regard to offers in compromise, during the review of the offer, the taxpayer has to remain in compliance. So what we will often have is a taxpayer will come to talk to us in April and say, I just filed my, let's say, coming up, my 2020 return, and I'm ready to file an offer. I want to include 2020. Okay, no problem. But that means you must remain current with any estimated taxes that you have for 2021, so that when the case is assigned, you're current going forward. The IRS doesn't want you to send in an offer and then accrue new liabilities. So the taxpayer needs to understand they can't just continue to accrue new liabilities. They have to stop, send in the offer, and stay current going forward. There is a currently not collectible status, and this is a very important status to keep in mind during COVID. There are taxpayers who we have who had offers in compromise that were already accepted or installment agreements that they were paying, and they have lost their job or had a decrease in income such that they don't have the ability to pay it anymore. You can go back to the IRS and you can demonstrate to them that the taxpayer is currently not collectible, meaning that they have legitimate expenses that are greater than their income, taking into consideration the collection financial standards, and they don't have the ability to pay the amount anymore. The IRS has been particularly kind over the last few months because of COVID, and these non-collectible statuses, these uncollectible statuses, will stay on the taxpayer's case for 18 to 24 months. So even though you might set it up right now, once they input this information for the taxpayer, they will be uncollectible for 18 to 24 months. That doesn't mean that the liability goes away, but it doesn't extend the statute. It doesn't toll the statute of limitations. So the IRS will not take any collection action for this amount of time, and then we'll send another notice possibly 24 months from now, and then you have to send in new financials, and hopefully your financial circumstances are better and you have the ability to pay again. This just came out last week. There was some relief for taxpayers. So I don't find this to be so helpful, but I'll mention some of the facts. Taxpayers who owe less than $250,000 for 2019 can set up an installment agreement without providing a financial statement. So just for reference, the rule is generally when you owe less than $100,000, you don't have to send in a financial statement. So now they've increased that, but it's really related to 2019. So a taxpayer who owed from 14 through 18 can't necessarily use this to their benefit. The one thing that I do find very helpful from last week's notice is the IRS will automatically add new tax balances to existing agreements. So they are willing to add the 2019 balance. Revenue officers generally look down upon this because you'll set up an installment agreement and then they will add in this. They'll say, I don't want to add in a new balance. Why should I have to add a new balance? They just accrued another balance, but now they are doing that to try to help taxpayers who've been affected by COVID. Two very important ways, tax collection devices that you should keep in mind, and these have become very useful now given that the rates are really low and that taxpayers are generating liabilities that they didn't anticipate. One is a discharge of federal tax lien application. This application can be used to release a lien even when there aren't sufficient proceeds from the sale. So you file the specific form, it's a 14135, and let's just say that the taxpayer owes $500,000. If they are able to sell their property and give the IRS $200,000, the IRS will accept that $200,000, release the lien so that the buyer can buy the property free and clear. And while the rest of the liability for the taxpayer won't go away, they will no longer have a lien, which is very helpful. And they may end up renting a piece of property, so there won't be a lien filed at all. These cases are a bit tedious, and it's important that you get to the right advisory agent. So New York has a set of advisory agents. You have to get the information to them. A lot of this stuff happens very quickly because the buyer doesn't want to wait 3 or 6 months to have the discharge go through. So I would say generally in our experience, it takes 3 to 4 weeks from the date that the discharge application is submitted until the lien is, the conditional commitment letter is issued by the IRS, by the advisory agent, so that you can then send in all the closing documents and the check for the amount that you're able to come up with from the closing, and then they will release the liens. And this has become a very, very helpful tool for taxpayers who generated liabilities.
This sometimes gets very complicated because if there is an existing mortgage on the property and the mortgage is going to get resolved for a lesser amount than the face amount that's owed, you have to go through a short sale process with the bank, which is very, very time consuming. So coordinating the two, it becomes a little challenging, but it can be done.
These are just some of the forms for you to look at, and I'll just breeze through, but these are the way some of the forms look. One just quick note on discharge, federal tax liens, and criminal restitution. Anyone who has a criminal case where there's restitution that's been assessed, there is when you release the lien and you pay the restitution, the Department of Justice will release their lien. There is a separate set of liens from the IRS. And this is a difficult process. It took me a couple of years to figure out that there is a unit in Austin, Texas, that monitors the payment of these restitution cases. And they can be contacted and they will help you work through releasing the IRS's liens for the restitution. So I show you that notice on the right, just so you can see the language that goes into these lien notices with regard to restitution.
When the restitution assessment is made through the Department of Justice, the IRS doesn't give credit for the tax that's been paid for those years until all of the restitution has been paid. So it floats out there as nothing has been paid. And of course, we know that that's not true because many times we've paid the money on behalf of the client to make sure it goes to the right place. So coordinating the Department of Justice and the IRS is sometimes a little hairy, and they have a crazy procedure where there's a single person assigned based on a letter of an alphabet. So somebody has K's and L's, you got to get to that person or you can't get anything accomplished.
I haven't hit every letter yet, but I have a good chunk of the letters. If anyone has a question or needs to get a hold of that.
Getting close.
The other one I'll mention before I turn it over to Rich is subordination of federal taxing applications. This is particularly helpful for people who want to refinance right now. So you have a lien and you owe a balance due to the IRS, and you want to refinance because you're paying 4.5% interest when now the rates are closer to 3%. So you can send in a subordination application, which will allow the IRS will agree to move behind the bank and be a junior creditor to the to the bank in exchange for payment from the refinance. So if you're going to come up with cash of $150,000 from the refinance, you can use that money, pay it towards the IRS balance that's due, and the IRS will subordinate their lien. And you have to work, this is slightly different from a discharge application. You really have to work in conjunction with the advisory agent so that you can work through the refinance and get the IRS paid. But it is very helpful and something to think about given that rates are low. This is just the second page of that form for you to see the two different ways that you can send in the subordination application. Okay, one last thing, audit reconsiderations. Taxpayers all the time are sent notices that they don't necessarily understand. They don't call their accountant, or their accountant doesn't necessarily answer the question, and then they end up with a balance that isn't due. Audit reconsiderations are very important and critical pieces of our practice because you can often go back to the IRS and show that the balance that was assessed should not have been assessed. Okay, so there are many different ways for doing that. I often find that I like to start by going through an IRS 911, which is a request for a taxpayer advocate. They will get involved. They're an intermediary service between the IRS and the taxpayer. You will position your case. They will get it back to the agent who made the assessment, and you'll be able to renegotiate. And you can get rid of many, many tens of thousands of dollars of balances. So it's very important to think about this for taxpayers who have balances that they should not have owed for.
So also very useful sometimes to begin that process with a freedom of information request, so you can get all the information that's in the government's file. You can see where the audit went bad. Perhaps something was misunderstood or not submitted on time, or not submitted properly to the agent, or there's a relationship issue between the agent and the tax preparer who's handling the audit. And you can oftentimes turn that around and get the right result for everybody's sake.
Why don't you talk a little bit now about some of the criminal issues while we have a few minutes left?
Okay, so why is there a need for tax enforcement, criminal tax enforcement? It's obvious. There's a tax gap, last count, of $441 billion. 16% of the taxes that should have been collected are not collected. 80% of that arises from underreporting of income. We are now, I guess, having a new president. I don't know how to read the tea leaves as to what's going to happen. The current commissioner may or may not be reappointed. Chuck Reddick, who is the current commissioner, is thought to have done a very good job with the resources that Congress has given him. But the new president obviously has the ability to get a new commissioner. Where that'll lead us, I don't know. But there likely is going to be another stimulus bill. The government needs money, and it's likely that they are going to seek greater enforcement by the IRS and perhaps even beef up their budgeting. Every dollar that they spend on tax enforcement yields $4 of collection. So it seems to me, just in a business point of view, that it's a kind of a no-brainer. Beefing up the collection part and the criminal investigation part of the IRS is going to yield a lot of dollars. If a client has underreported his income for 1 or more years or not filed for a series of years, now would be a very good time to consider coming forward before there's an audit, before there's a criminal tax investigation, with a disclosure. There are separate rules for the state and the federal government. The IRS has their own rules, which recently changed at the end of 18. Under the IRS's rules now, post 2018 tax year, you have the right to apply for a disclosure, but they will automatically assess a 75% fraud penalty on the highest year that's due, which if you want to change that, you have a right to change that to a substantial underpayment penalty for all of the years. New York State does not penalize you in that respect. They have no penalties. They have a reduced interest. They have a very simple process, but both are something to be considered because both will likely result in no criminal prosecution. It's a not every taxpayer feels that having to pay all of that money for the back taxes is worth a year, not serving a year into a jail. But we try to caution them that it's not as much fun as it looks like on the movies. So how do you get caught? Well, audit lottery, number one. 1 out of every 222 tax returns, individual tax returns, are audited. That's less than 0.5%. So audit lottery is a game that many taxpayers play, but it's a dangerous game. If you are in a situation where you have what's called an eggshell audit, an audit where we have to kind of walk on eggshells because we know, we've been already told either by the preparer or by the taxpayer that there are issues that are troublesome. And there are many ways of handling that during the audit, which range from coming right out and telling the agent that there's a problem, which involves some danger, obvious danger, or hoping that you can kind of get through the audit and answer the questions truthfully without giving any additional guidance to the agent as to what the problems are. There are, on slide 55, there are a list of triggers that will cause a civil examination to turn criminal. If they catch you omitting entire sources of income, concealing bank accounts that they find out about, failing to deposit all your receipts in a business bank account, or cashing checks. Cashing checks is a huge thing, which we'll talk about in a moment. If you have expenses that can't be substantiated, that are large, some indications of fraud is a multiple set of books, failure to adequately keep good records, invoices that are irregularly numbered, kinds of trigger things. So those are things that agents are trained to look at. And when they see those things, they consider a fraud referral. Now, fraud referrals by a revenue agent are not taken lightly. There's a special process that they have to follow. They have to fill out a form. After the form is filled out, it goes to the fraud technical advisor. The fraud technical advisor makes an independent decision whether or not a fraud penalty is appropriate civilly or whether the case should be referred criminally. If the case is referred criminally, you will hear nothing further from the civil agent. And that is the indication. When they stop returning your phone calls, there is an indication that that case may have turned into a criminal investigation. You might not hear for a year. You might not hear for 9 months because there are many, many cases. These special agents are overworked. It goes into somebody's inventory. It may be a long while before they get to it. But the fact that you're not hearing and you're not hearing from the manager, nobody's returning your calls, it's not a good sign. The next is collection fraud. That's something that the IRS has now been emphasizing. They have specially trained revenue officers to look for collection fraud, assets that are omitted from the financial statement, the 433A, or undervalued substantially without cause, All of those things are something that triggers a collection agent to refer a case for criminal prosecution as well. The most common and the most emphasis now with the Internal Revenue Service are employment tax cases. These typically arise from an examination of check cashing institutions that, surprisingly to our clients, keep very detailed records. The IRS goes in with a summons. They ask for copies of a list of every check cashed by a particular taxpayer, say more than $10,000. They come up with a list over the last 3 years, 4 years, might be $1 million, $2 million. They go to the taxpayer and they say, okay, look, you have $4 million of checks that you cashed. You only reported $1 million worth of gross receipts. What happened to the rest of the money? So half the case is gone. The money's now in their hands. So the money might have gone for payroll, where now you have a payroll tax case, might have gone for material, and then you have a false return case possibly, although no income tax consequences, or it might have gone in the pocket of the proprietor, or a combination of all of these is what we see generally. So these employment tax cases are just rampant, particularly in Long Island. They are sometimes done federal and state joint prosecution. When things get hairy, they also get involved, the state workman's compensation, state unemployment. It just goes on and on. So it's a very dangerous place to be for taxpayers. Criminal cases are generally resolved. Unfortunately, criminal tax cases are 98% of them are resolved by plea. The reason for that is these cases are well investigated. The individual defendants are not picked out of the phone book. There's good reason that they've been investigated. The investigations are done thoroughly. There's many levels of review. And by the time it gets down to the U.S. Attorney's Office, there's almost no place to go but a plea. And the sentencing guidelines give you a good reason to plead guilty to a case in a particular charge rather than trial, because the results of trials are not statistically good. So are we out of time? Yeah.
John, are we out of time?
Yeah, we just ran out of time, and I want to be respectful of all the attendees who know this is a half hour long. So we'll definitely get you back on for another session. I'm sure if anyone has any follow-up questions, they could reach out to you directly. Just a few more housekeeping items. I'll be sure to include their email address, both Richard and Scott's email, and the follow-up to this program. And as I mentioned at the onset, the goal of these programs is to stay up to date in timely wealth management related topics and to collaborate where appropriate. I think we can all agree that the clients who are best prepared are the ones who are served by a team of knowledgeable advisors. Just one more item before I let you go. My next program and the final one of my fall webinar series is on December 3rd at 8:30 a.m. and is entitled Tax Planning for Expatriation, featuring Eli Akhavan, Senior Counsel at Norton Rose Fulbright, based in New York City. You'll be receiving an email tomorrow morning with more details and registration information for this and all of my upcoming programs, and I hope you can attend. And with that, this concludes today's session. Please stay safe and healthy. Have a wonderful day, everybody.
Thank you.
Thank you.